Hi there. In this tutorial, we're going to make two more adjustments to our income statement before we can calculate our value drivers and work on our forecast. So there's two things I want you to notice. First is that we have our revenue, sales revenue, total revenue. Then we've got direct costs, right, otherwise known as cost of goods sold. And total revenue less direct costs equals gross profit, right? That's a subtotal. Then we have a few more expenses: selling, general, and administrative, and restructuring, remediation, and impairment. And the total of those two is our total indirect operating costs. Then if we take our gross profit and subtract those total indirect operating costs, we get operating income. Then we've got interest income, which is our only, at least Hershey's only, non-operating income. Then we can calculate earnings before tax, our income tax, and our net income. Well, there's a couple of things here. The first is that you notice there's no depreciation expense. Well, depreciation expense is important because it allows us to reduce our earnings before tax and therefore reducing our tax expense, our taxation expense. So we need to find our depreciation expense because we need to forecast that separately. Because depreciation is based on the amount of fixed assets that we own, not on sales. Well, Emergent doesn't include depreciation as an expense. Instead, it's hidden in here with direct costs. It's actually considered part of cost of goods sold as far as Emergent's concerned. And we need to pull it out. We can find the value of what they had as a depreciation expense on the statement of cash flows. And then we need to come in here and back it out. We need to pull it out of this number. So I like to enter a couple of rows. And then we're going to enter something. We're going to enter a depreciation expense. Depreciation and amortization. So now we've got to go to our standardized statements and look for the statement of cash flows. And if we scroll down on the income statement, scroll down through the balance sheet, scroll down to the statement of cash flows, we can find our depreciation expense. Nope. Oh, is it only on the as reported statements? It is. As reported. Depreciation and amortization. Phew. I can't just copy that whole row because these are deleted. Are those actually? I'm cheating. Well, not really. These aren't actually, it's not really important to delete these columns, but if you delete those columns, it'll be easier to grab your depreciation and amortization. I can copy it, take it back here. There we go. Now we have a depreciation and amortization expense. We can't just leave it at that though, because cost of goods sold already included this number. For instance, gross profit should be equal to total revenue less cost of goods sold, right? And if I undo that, you can see that that number's the same. Well, that's because depreciation and amortization is included in part of this costs. So you need to come back here, and for each direct cost, subtract that year's depreciation expense, depreciation and amortization expense. You put an equal sign in front and then subtract that year's depreciation and amortization expense. So for 2010, it'll equal the number that it gives you on Emergent. However, we've got to back out. We've got to subtract depreciation and amortization because we need to know what that is because we need to forecast it. Now our gross profit is going to equal total revenue minus direct costs minus depreciation and amortization. And if you check that, it'll work. right? Just double check that you did it correctly. Now we have a depreciation and amortization row. You don't need to worry about its common size percentages. Depreciation and amortization isn't related to sales. Instead, it's related to plant, property, and equipment. All right, we'll do one more tutorial for dealing with interest income, and then we'll move on to finding these value drivers.